Welcome to The Explainer. Today we're unpacking something absolutely fascinating, the shifting architecture of Africa's private capital markets. We'll be diving deep into the latest, highly anticipated data from AVCA, the African Private Capital Association. Look, if you're an institutional investor, a fund manager, or just someone tracking where the smart money is actually moving across emerging markets right now, you are definitely in the right place. We're going to look way past the headlines and figure out exactly how the African capital stack is being fundamentally re-engineered for 2025.
Okay, let's start by zooming out to the global macro picture. This quote from Cazenove Capital, it perfectly hits the nail on the head regarding the anxiety global family offices and large allocators are feeling right now. We have officially reached the end of the zero interest rate era. Quantitative easing is over, and suddenly, capital is very expensive worldwide. As a direct result, global investors have completely retreated. They're prioritizing resilience, trying to mitigate policy risks, and taking a much more cautious approach to deploying capital. And naturally, this global pullback set off a chain reaction that hit emerging markets hard.
Which brings us to this dark number right here, 22%. Back in 2023, largely thanks to that broader macroeconomic instability, Africa's total private capital deal value dropped by a massive 22%. It was a sharp, historical decline, a real reset for the continent's investment landscape. But, and here's the secret about capital markets, a drop like this doesn't actually mean the ecosystem is failing. It means it's recalibrating. The stakes were set, the easy money was gone, and the market literally had to pivot to survive. So here's exactly how that pivot is playing out. First, we'll look at global headwinds versus African resilience. Second, venture capital's continued dominance. Third, the rise of private debt. And finally, climate, tech, and financials.
Let's jump right into Section 1, Global Headwinds versus African Resilience. So looking at the drop from 2022 to 2023, you can really see that historical decline we were just talking about visually anchored right here. Deal value fell from $7.6 billion down to $5.9 billion US. This was the exact moment capital became globally expensive. The era of endless fiscal stimulus was over, and investors just pulled back their term sheets. But while the prevailing global narrative assumed this was the start of some prolonged dark age for African private capital, the reality on the ground was already shifting.
Here is the absolutely crucial point. While global regions were seeing this massive pullback, Africa actually posted an 8% year-over-year growth in final transaction close values in 2024. Local, Africa-focused fund managers drove a $4 billion resurgence. And where did that money go? Infrastructure. We saw a huge local push, driven by players like the African Infrastructure Investment Fund 4, which closed at $748 million, targeting renewable energy and digital infrastructure. We even saw pension fund consortia pooling their resources, like the Kenya Pension Fund Consortia. Basically, local capital stepped up the second global capital stepped back.
Moving right along to Section 2, Venture capital's continued dominance. Now, if you thought VC in Africa was still in freefall, well, the 2025 metrics definitely prove otherwise. The market is stabilizing, folks. In 2025, venture capital still commanded a super impressive $2.1 billion in deal value, making up a massive 68% of all private capital deal volumes. And check this out. The median deal size actually rose 33% to $4.0 million. This tells a fascinating story. Capital deployment is shifting strategically. Investors are moving away from that old spray-and-pray early-stage approach, and instead they're concentrating their capital into fewer mid-sized deals with companies that actually have proven business models. It's all about selectivity and scale now.
All right, Section 3, the rise of private debt. When we compare these two asset classes, it reveals a massive shift. Venture capital sits at $2.1 billion, which is a 21% year-over-year contraction. But look at venture debt. It's sitting at $1.8 billion, representing a staggering 91% year-over-year growth. I mean, private debt is catching up to equity at breakneck speed. For the very first time, debt is acting as a primary catalyst in the venture space, making up nearly half of the entire deal value.
So what's the big takeaway here? We really have to reframe how we view debt in emerging markets. This is not a failure of equity financing. Actually, scratch that. It's an ecosystem evolution. Private debt has emerged as the ultimate stabilizer. It's enhancing liquidity and sustaining transaction activity in an environment where equity is constrained. Specialist managers like Sahel Capital and Verdant Capital are driving this, especially in heavy sectors like logistics, asset financing, and renewable energy. It gives founders non-dilutive capital and gives investors a safer position in the capital structure during uncertain times. It's a huge sign of a maturing market.
Finally, Section 4, Climate, Tech, and Financials.
Breaking down the sector dominance. Climate is the undisputed heavyweight champion in 2025. It captured a massive $1.5 billion. That's 40% of all deal value. Investors are aggressively funding climate-related ventures. Meanwhile, financials accounted for 30% of all deal volumes, proving that digital financial infrastructure is still very much the backbone of the continent's growth. And underlying the whole shebang is tech. 82% of all capital recipients were tech or tech-enabled companies. So the playbook is pretty clear for sure. If you are building digital financial rails or solving climate adaptation, you definitely have the market's attention. It's also absolutely vital that we provide some demographic depth to this ecosystem analysis. When breaking down the funding for female and gender-diverse founders, the data objectively shows there are still major disparities. For example, the median deal size for female-only founders in 2025 was 68% lower than the continent's overall median. However, what's really crucial to understand is the untapped potential here. Recent studies, including research focused on small businesses in places like Senegal and Kenya, note that women-led firms in Africa are actually more likely to adopt sustainable strategies and adapt effectively when facing extreme climate events. So, considering climate tech is capturing 40% of deal value, capital allocators would be super wise to align their strategies with these highly adaptable demographics.
All right, let's look at the ultimate proof of maturing ecosystem: liquidity. The rise of the secondaries market in Africa is a total game changer. Secondary transactions represented half of all exits to financial sponsors in 2025. This market is facilitating real liquidity for early investors. Just look at Lemfi, a digitally enabled bank. They had a $53 million secondary sale to Highland Europe that delivered a massive 29x return to its early investor, Silverbacks Holdings. No way, right? It proves that early investors aren't just trapped. There is now a liquid secondary market allowing them to realize astronomical returns and recycle that capital right back into the ecosystem.
We've covered some incredible ground today. We've seen how global headwinds forced a massive local resurgence, how venture capital stabilized through mid-sized deals, the explosive rise of private debt, and those massive opportunities in climate and fintech. So I want to leave you with this provocative thought. In a market that has officially survived its freefall and is now actively maturing, how are you going to adapt your capital stack? The zero interest rate era is absolutely over. But as we've seen today, for those willing to embrace debt instruments and local resilience, the African private capital market in 2025 is more robust and sophisticated than ever before. Thanks for joining me for this explainer, and keep looking for the signal in the noise.